If you've watched more than just a few housing market videos, you've probably been told over and over again that we are not in the middle of a 2008 repeat, that the market then was completely different, and it was. But there are also some eerie and honestly concerning similarities between then and now, and we're going to talk about those today. Well, hello, this is Wendy Pinnell, and for many of us, the financial crisis of 2008 is really just a distant memory, and that's if you remember it at all. But with the current state of the housing market, we need to face the facts that there are some similarities between now and then, right? And if we're going to learn from history, we need to be aware of what indicators could trigger another housing meltdown. So with that in mind, I want to walk through all the ways today's housing market is a heck of a lot like the one we saw in 2008. First of all, let's talk about consumer debt. One huge similarity between now and 2008 is high consumer debt levels. In 2008, if you had a pulse, you could get a mortgage. So you saw a lot of that debt in the form of cash out refinances or home equity lines of credit. As home values spiraled upward, homeowners would just refinance over and over again to support their lifestyles. They didn't really have to show that much documentation to keep being approved. In today's housing market, the consumer faces much stricter requirements for mortgages, but that doesn't stop them from acquiring other consumer debt. In fact, according to the Federal Reserve Bank of New York, total household debt increased by 2.4% in the fourth quarter of 2022, taking it to an all-time high of 16.9 trillion. This is even higher than what was seen before the start of the Great Recession. In fact, a survey conducted by Bankrate in January indicated that 36% of respondents said their credit card debt is higher than their emergency savings. Bankrate went on to explain that this amounts to a record high over the 12 years the poll has been conducted. Now, on top of this, U.S. household debt climbed at the fastest annual pace since 2008. According to Chris Horomiski, in 2022 alone, more than $1 trillion was added to the overall debt carried by consumers in 2022. He describes it as an extraordinary increase not seen in over a decade. Now, what complicates things for today's consumers is their rising consumer debts are going right along with interest rates. This means that those who are already heavily in debt can't just rely on refinancing as a way out, right? They're going to have to tighten their belts and pull in their budgets, or they're going to end up stuck with debt they can't keep up with. Another big thing we're seeing in common is the underwater homeowner. This is commonly known as being upside down on a mortgage, and it happens when homeowners owe more than their home is worth. Well, in 2008, rising interest rates and falling property values led many homeowners to become upside down on their mortgages. At that time, a lot of these borrowers were doing cash out refinances one after the other, right, to support those lifestyles. Well, when the market crashed and home values dropped, they had no equity to fall back on. Well, according to Black Knight, in the here and now, 8% of all homes purchased with a mortgage in 2022 are now underwater. They also said of FHA VA mortgage holders, 25% have fallen into negative equity. Now, the good news in today's market is there are far fewer homeowners in this position, okay? People who bought their homes before the pandemic typically have plenty of equity. It's those who bought in 2021 or early 2022 who generally have less than 10%. Now, homeowners with FHA and VA mortgages are at an even higher risk of becoming upside down because they started out with low down payments and very little equity in the first place. As long as there are no major hiccups, today's underwater homeowner can continue living in their home and just, build equity back up over the years. There's no real immediate crisis. The financial impact becomes real when the homeowner runs into financial difficulties, okay? Because they can't just sell their homes because they owe more than the home would sell for. In 2008, that triggered massive foreclosures and the market crashed. A lot of those people couldn't afford their house payment in the first place, right? So you just had people walking away from their homes in droves. Well, today, homeowners were more qualified for their homes, but that doesn't mean they won't run into financial difficulties in other ways. For example, what we just talked about, being trapped by high consumer debt. And again, when they do, that's when you start seeing massive foreclosures. In 2008, we had underwater homeowners that brought on a crash. Now, as of today, we have underwater homeowners all over again but this time they're starting out with better income and better credit scores. So time is going to tell whether or not these homeowners end up triggering a lot of foreclosures. It's basically a risk factor. This issue, along with that increasing consumer debt we talked about, is definitely something that could go south on us. Well, a third similarity you see between 2008 and today is the Federal Reserve taking extreme and aggressive action with their policy rate that ends up triggering a recession. In both times, on the front end, you see lower than usual rates, right? And what do those do? Well, they stimulate the economy. Inflation rises. Janaea Bowens describes how, similar to today, high gas prices pushed inflation up to more than 5% in 2008. I hate to say it, but today we can only wish for a 5% inflation rate, right? Greg Iakursi explains that inflation had a 9.1% peak in June of 2022. As of right now, today, inflation stands at 6.4%. Well, following the period of low rates, you see the Fed raising interest rates quickly and aggressively because they've let the market get overheated. The 2008 rate hikes triggered a massive housing crash. The homeowners then mostly had adjustable rate mortgages. So when those rates went up, their mortgage payments went up, and really the crash was like inevitable at that point. Well, let me just clarify what we don't have in common with 2008 is the adjustable rate mortgage wildcard, okay? Remember when we discussed underwater homeowners? Well, those are primarily the ones who bought after the pandemic. Now, that being said, Lance Roberts points out that a recession or hard landing followed the last 5 instances when inflation peaked at 5%, and currently inflation is well above 5%. So when it comes to mortgages and the types of mortgages, 2008 is very different than today. But when it comes to all the symptoms that drive a recession and the Fed aggressively manipulating rates, we've got a lot of disturbing similarities there. In fact, Brian Jung points out that the United States is approaching a recession as a closely watched economic index dropped for the 10th straight month in January, for the longest slump since the Lehman Brothers collapse in 2008. He continues, the Fed's decision in its next few policy meetings will play a large part in determining whether the U.S. economy will achieve a soft landing or a crash. Ozildirim concludes that nonetheless, the conference board still expects high inflation, rising rates, and contracting consumer spending to tip the U.S. economy into recession in 2023. So if haven't lost you so far, similarity number 3 is the Fed manipulating rates into a recession. Now, speaking of being lost, no need to risk that with your move to Dallas. Check out our Let's Find Home questionnaire and let us guide you through the process. Finally, the 4th thing we're seeing in common, and I think this one may surprise you, is there is an excess supply of unaffordable new construction. Now, in 2008, we saw this in a huge way, okay? Entire neighborhoods of new construction just sat vacant. You know, if you've ever seen the movie The Big Short, you know that part where they drive through like a practically empty neighborhood of new construction? I can tell you, I was in the market in 2008 and it was absolutely like that, okay? Entire neighborhoods of new construction just sat empty while the builders went bankrupt. In fact, in our own neighborhood, okay, there was this huge area where they took away all the trees and completely cleared it. They built a few houses and then the builder went bankrupt. And the neighborhood just sat there looking incredibly ugly, just its few houses, like for years. Well, fast forward to the present, and you're probably thinking at this point that I have thoroughly discredited myself because everyone knows we have a supply shortage. Well, yes we do, and we also have excess supply at the same time, okay? It's all tangled up in this messy basket of unaffordability. You know, all this time, builders have been targeting the move-up buyer, okay, who can afford a more expensive home due to their equity when they sell, okay? A $600,000 home is not a particularly big obstacle when you're making $300,000 selling your current home, right? So those homeowners, you know, those would-be move-up buyers, they have a 3% interest rate on their current home, and they don't want to trade up for a 6% interest rate. So essentially what we have right now is we have all our move-up buyers. They're just kind of waiting on the sidelines for interest rates to go down, right? Meanwhile, your average first-time home buyer can't afford the upper price ranges. It actually does create this odd situation of there being both a housing shortage of affordable new construction and a surplus of higher-priced new construction at the same time. Wolf Richter wrote an article titled "Cut the Price by 20% and They Will Come." And I think, you know, that title all by itself, okay, encapsulates the current dilemma, right? Today's buyers can't afford the new construction that's out there. Richter reports that in the fourth quarter, Meritage home sales order volume collapsed by 46%. He continues explaining that sales order volume in terms of dollars collapsed by 52%. Meritage's executive chairman Steve Hilton comments that today's higher mortgage rates continue to pressure housing prices as monthly payments still remain above 2020 and 2021 levels. But you know what? Maybe you're skeptical. Maybe you've been told far too many times that we have a housing supply shortage. This whole idea that we could have a surplus like we did in 2008 is just a little bit too far out there. Well, I decided to take to the streets right here in Dallas to restore my reputation. So we're going to check out some suburbs and some new construction communities to verify this whole issue of supply and whether we actually have a shortage, which is what you've been told, or a surplus, right? So some things that we're going to be looking at, okay? We want to see month supply. Is it growing? We want to see how many homes each suburb currently has for sale. Also, pay attention to affordability. Like, how attainable are these homes for the average buyer? First, I checked out Mansfield. Now, Mansfield is located just south of Arlington, okay? It currently has 6.1 months supply of new construction, which is up 84%. Year over year. They currently have 167 homes for sale, which is an increase of 173%. So high month supply and increased inventory, definitely in Mansfield. We have that surplus of supply. But is it about affordability? Well, let's take a look at their South Point subdivision, okay? The average sales price here is $616,000, and homes are selling at an average of 92% of their list price. They're staying on the market longer, and they're selling like on an average of about like 97 days. Now, their M3 Ranch subdivision, just another new construction community in Mansfield, and it tells a similar story, okay? Homes there, they're selling at an average of $632,000. They're selling at an average of 94% of list price after sitting on the market like 114 days. So that right there tells you the story of Mansfield. Working our way southeast over to Midlothian, we find an 8.2 month supply of new construction, which is up 95% year over year. They currently have 166 homes for sale, which is an increase of 107%. Now, their Brandy Ridge subdivision is an excellent example of what you can find in Midlothian, okay? Homes are selling at an average of $658,000, and they're staying on the market for a while, okay? They're staying on the market for around like 85 days. Azalea Hollow is another example of a subdivision in Midlothian. Homes here are selling at an average of $1.29 million, and get this, they are staying on the market quite a while at around 201 days. So that is Midlothian, and again, what are we seeing? We're seeing excess supply, slow to move off the market, right? Now, if we go slightly further south and east of Midlothian, we have Waxahachie, okay? Waxahachie currently has 7 months supply of new construction, which is up 233% year over year. Okay, they currently have 139 homes for sale, which is an increase of 135%. Now, Enclave at North Grove is an example of a subdivision in Waxahachie. Homes are selling at an average of $541,000, and they're staying on the market, wow, around 278 days. Also, another example is the Oaks at North Grove, okay? And homes there are selling at a lower price, $438,000. That's the lowest we've seen so far. And they're staying on the market for 103 days. So that gives you a taste of Waxahachie. Again, a lot of supply there. Well, now we're gonna move up, moving north all the way up past downtown, and then slightly to the east, we find ourselves in Rowlett. It currently has 6.4 months supply of new construction, which is up 3.2% year over year. Now, they currently have 43 homes for sale, which is an increase of 19%. One example is their Magnolia Landing. Homes are selling at an average of $560,000. Some of the homes in Magnolia have been on the market for over a year. North Haven is another example of a Rowlett subdivision. Homes here are selling at an average of $579,000. They're staying on the market for a while too, like around 179 days. Heading further north and slightly to the west, we find ourselves in McKinney. It currently has 6.2 months supply of new construction, which is up, get this, 416% year over year. They currently have 147 homes for sale, which is an increase, again, huge number, 359%. Lake Forest is an example of a new construction community in McKinney, and homes are selling at an average of $838,000. And once again, they're staying on the market for a while, a good like 95 days or so. All right, well, finally, south and slightly west of McKinney, we have Frisco, okay? It currently has 2.8 months supply of new construction, which, get this, is up 211% year over year. They currently have 93 homes for sale, which is an increase of 200%. Now, an example of Frisco new subdivision is the Groves. Homes there are selling at an average of $987,000. They are staying on the market for a while as well, around 80 days. So really, we have just been all over Dallas, okay? We started south and west of Dallas, and we ended up north and west of Dallas, and we've seen the same thing, okay? There's a lot of higher priced new construction out there that's just kind of sitting there. It's taken a really long time to sell. And again, this is very similar to what we saw in 2008. But what about affordable new construction? Okay, we didn't really talk about where that fits into, the whole equation. Well, you might be pleasantly surprised to know that it does exist in Dallas, and we did a whole video about exactly where you can find it, which you can check out here. In the meantime, Wendy out.